Right now, something is happening to your money that most people don't fully understand. It's not dramatic. It doesn't happen overnight, but it is relentless. And if you don't understand it, and more importantly, if you don't act on it, it will quietly destroy your financial future. It's called inflation. And in 2026, it's back with a vengeance. Today, we're going to break down exactly what inflation is doing to your purchasing power, what's driving it, and most importantly, the specific strategies that the smartest investors in the world are using right now to not just survive inflation, but to profit from it. This is Potensia. Let's get into it. Let's start from the beginning. What actually is inflation? Inflation is the rate at which the general level of prices for goods and services rises over time. When inflation is running at 3.3%, which is exactly where the US is right now as of March 2026, it means that something that cost you $100 last year costs you $103.30 today. That doesn't sound catastrophic, but let's run that math forward. At 3.3% inflation, in 10 years, that same $100 worth of goods costs you $138. In 20 years, $191. The dollar in your pocket today is worth less than 53 cents in purchasing power terms 2 decades from now, if inflation continues at this rate. Now here's the part that most people miss entirely. It's not just the prices of things you buy that matter. It's what inflation does to the money you're saving. If your savings account is paying you 0.5% interest, which is roughly the national average for a standard savings account, and inflation is running at 3.3%, you are losing 2.8% of your purchasing power every single year. You're not breaking even. You're going backwards. Silently. Automatically. While you sleep. To fight inflation, you need to understand what's causing it. And in 2026, there are 3 primary drivers. First, the energy shock. The conflict in Iran has sent global energy prices surging. Gasoline is up nearly 19% year over year. Fuel oil is up 44%. And because energy is an input into virtually everything in a modern economy, shipping, manufacturing, agriculture, heating, those price increases ripple through every sector. When it costs more to move goods, the goods cost more. Second, tariffs and supply chain friction. Tariffs introduced in recent years are still working their way through the supply chain. Companies have been quietly absorbing those costs, but that window is closing. The price increases that manufacturers and retailers have been deferring are coming. Economists expect a second wave of consumer price increases in the second half of 2026. Third, government spending and money supply. Years of elevated government spending, combined with historic levels of debt, have expanded the money supply significantly. When more dollars are chasing the same amount of goods, prices rise. That's inflation at its most fundamental level. The OECD, one of the world's most respected economic forecasting bodies, is projecting that U.S. inflation could reach 4.2% by the end of 2026. The Federal Reserve, at its March meeting, quietly revised its own inflation forecast upward from 2.4% to 2.7%. Both numbers suggest that inflation is not going away quickly. So what do you actually do about it? The answer is both simple and profound. You stop being a saver and start being an investor. Savers keep their money in cash or low-yield accounts. Inflation destroys them slowly. Investors put their money into assets that rise in value as the dollar loses purchasing power. The inflation does the work for them. Here are the 5 most powerful inflation-fighting assets available to ordinary investors right now. Number 1, real estate. When inflation rises, so do replacement costs and rents. A property that generates rental income automatically adjusts its income to the inflationary environment. Real estate is the single most time-tested inflation hedge in history. You don't need to buy a building. REITs give you real estate exposure through the stock market, with current yields above 3%. Number 2, equities, selectively. Not all stocks are inflation winners. Companies with strong pricing power, the ability to raise prices without losing customers, perform well in inflationary environments. Energy companies, consumer staples, and certain industrials fit this profile. Avoid rate-sensitive sectors like utilities and bond proxies. Number 3, commodities. Oil, natural gas, agricultural products, industrial metals. These are the raw inputs to the economy. When everything gets more expensive, The things everything is made from get more expensive first. Commodity ETFs offer diversified exposure without the complexity of futures trading. Number 4. Gold. The oldest inflation hedge in human history. Gold futures are currently trading around $4,738 per ounce, near all-time highs. And with geopolitical uncertainty elevated and fiat currency credibility under pressure, the case for gold remains strong. Number 5. Inflation-protected securities. Tips. Treasury inflation-protected securities. Automatically adjust your principal with the CPI. I-bonds from the U.S. Treasury are currently yielding 4.03%. These aren't exciting. Inflation is not your enemy if you understand it. It is simply a transfer of wealth from those who hold cash to those who hold assets. The question is which side of that transfer you want to be on. The good news is that the answer is entirely in your hands. The tools exist. The assets are accessible. The knowledge is here. This is Potensia. Subscribe and join the inner circle. Next week, we're going deep into the S&P 500, where it's going, what's overvalued, and exactly where sophisticated investors are finding opportunity right now. Until next time.